Markets change, technology change, algorithms evolve, new tools appear every single year, but there is one thing that has never changed in financial markets, and that is human behavior. Fear, greed, optimism, panic, and all those emotional forces have been driving markets for over 100 years. And because human behavior doesn't really change at an evolutionary level, certain trading strategies have continued to work decade after decade. And the strategies that I'm going to share with you in this video aren't secret formulas or shortcuts. They are simply ways of observing how crowds behave in markets and then taking advantage of those predictable and reliable next moves. So in this video, I want to walk you through 5 trading strategies that have stood the test of time. Strategies that traders have used for decades and why they work. All right, let's start with strategy number 1, trend following. The first strategy is one of the oldest in trading. It's trend following. And the basic idea is quite simple. Markets tend to move in trends. Prices rarely move in straight line, but they often move in directional waves over time. Uptrends, downward trends, and sideways phases. Trend following simply means trading in the direction of the prevailing trend, buying in uptrends, selling in downtrends, and this strategy has been used by traders for decades. And it works because trends often reflect large institutional money moving into or out of markets. And those flows rarely happen instantly. They develop over time, which then creates opportunities for traders to join the move. The biggest mistake that beginner traders make with trend following is trying to catch the very beginning of the trend. Professionals are happy to enter just as the trend started to move, because confirmation of the trend reduces risk. Strategy 2, support and resistance trading. So the second timeless strategy is support and resistance. Markets often react around certain price levels, and these levels represent areas where buyers or sellers previously became active. Support is an area where price has previously found buyers, and resistance is an area where sellers have previously stepped in. And these levels work because traders remember them. Institutions remember them. Orders accumulate around them, which means when price returns to those areas, reactions often occur at those levels again. And this is often why traders watch previous highs and previous lows and key round numbers. So it's about identifying where supply and demand might shift. The third strategy that's worked for decades is breakout trading. Markets often spend long periods of time moving sideways, and it's known as consolidation. And during them periods, buyers and sellers are roughly balanced, but eventually one side gains control. And when price breaks out of that range, it often triggers some momentum. New traders enters, stop loss get triggered, and price can move quite rapidly. And breakout traders, they attempt to capture these moments. They look for strong moves beyond important levels, and they aim to ride the momentum that follows. This strategy works because crowd psychology often accelerates the move once important levels break. It's like herd mentality. The fourth strategy is a mean reversion. And this approach is based on a very, very simple observation. Markets rarely move in a straight line forever, but when price moves too quickly in one direction, it often corrects back to the average. It reverts back to the average. And mean reversion traders look for overextended price movements or situations where markets may have moved too far in the short term, and they look for the opportunities to trade the move back to equilibrium. The reason this strategy works is because extreme moves often trigger profit taking, and those corrections can create opportunities. However, one thing I'll say with this one is timing is important, because strong trends can continue longer than expected. So you have to be able to stomach that and weather the storm. And the final strategy is momentum trading. Momentum traders focus on markets that are already moving strongly. So rather than predicting reversals, they aim to capture continuation. And the idea is very, very simple. Strong moves attract attention. As the more traders notice the move, more participants enter, and that increased participation can accelerate the trend even further. Again, momentum trading often works because of herd behavior. Once a strong move begins, traders tend to follow it, and that can create some very powerful trends. Some ways you can look for momentum is stronger candlesticks in a bullish move, or stronger candlesticks in a bearish move. You can also look at a combination of exponential moving averages, and if they're fanning out in the right order, that can indicate a continuation of the prevailing trend. Also, you might use some kind of stochastic and look for something called convergence, where you have higher highs on the stochastic and higher highs on price, indicating that the prevailing trend will continue. Now, here's the important thing to understand. None of these strategies work all of the time. Every strategy experiences losing trades, periods of drawdown, and market conditions where they just perform poorly. But what really matters isn't perfection. What matters is understanding when the strategy tends to work best, and then managing risk properly when it doesn't. Trading success is very rarely about finding the perfect strategy. It's about executing a sound strategy consistently over time. And when I say sound strategy, what I'm talking about is you want to pick one that resonates with you, one that suits your personality, one that suits your lifestyle, one that you can actually trade consistently in your life, and then one that has enough frequency for you to feel comfortable with it. So there you have it, right? Markets might evolve, technology might change, but the underlying forces driving markets remains the same. It's human behavior. It's fear, it's greed, it's momentum, and crowd psychology. That's why strategies based on these behaviors continue to work decade after decade. So the key isn't to constantly search for new strategies. The key is understanding why the strategies work and then developing the discipline to execute them consistently over time. In trading, simplicity is what outperforms complexity. And the strategies that survive the longest are the ones built on timeless principles of human behavior. So if you like what I've covered here and you want to learn more about these strategies, check out some of the resources that I stick in the description and in the pinned comment. I highly recommend you check out my 30-day trader challenge, because we'll go through all of this and we'll build a strategy and you'll have more confidence on placing your first live trade in 30 days than you'll find anywhere else online. And until next time, take care and I'll see you in the markets.